hello, welcome, or I guess I should say welcome back to the same room. Um, you are all joining us for the Real World Finance, Payments, Assets, and Utility at Scale panel. We're going to start with some brief introductions, name, role, project. I'll briefly introduce myself and then just pass it down the line. My name is Pierce Carville. I'm a partner at A16Z Crypto, where I lead go-to-market, which effectively just means helping our portfolio companies grow and scale. And I'll pass it down.
Thank you very much. I'm Jem, Director of Partnerships at Stellar Development Foundation. I joined from Circle. Um, Stellar is an open network layer one, been out there for the last 10 years. We're built for payments and stablecoin before stablecoin wasn't even a term.
Ashar this side. I work at Polygon. I've been here for like 4 years now. I head the global team for payments and tokenization.
Hi, I'm Nelly. I am from the Monet Foundation team. So Monet's the latest and most performant EVM L1 blockchain on the market.
Hi, morning, everyone. My name is Nikhil Joshi. I'm the COO of Emergo. Emergo is a co-founding entity of the Cardano blockchain. We're actually headquartered here in Singapore, so welcome, everyone, to home turf. Our mandate has historically been to help commercial integration of the blockchain, but now we basically set ourselves up as a Web3 finance company.
Great, thank you. And I think to kick it off, we just to familiarize everyone in the room with your projects and how you approach traditional finance and institutional markets. There's a lot of different adoption angles that we're seeing play out currently, whether it's payments, tokenization, scalability, asset rails, et cetera. Would you mind just explaining for everyone what part of the traditional financial core infrastructure you're most focused on trying to revolutionize? We could just pass this one down again.
Sure. So we are focusing on payments. When I mean payments, we focus on cross-border payments, meet-to-meet transactions, and also aid and mass disbursement payments. We work with institutions like MoneyGram, United Nations, and WisdomTree and Franklin Templeton. We also focus on tokenization and regulated issuers. What sets up difference is also our on and off ramps and global footprint. So anywhere in the world, you can use Stellar-based assets to use in different payment flows, whether cross-border payments and other type of payments.
Go ahead.
Yeah, I can. So I think at Polygon also, like what we are focusing on is payments and like tokenization. And one of the good things about Polygon has been like every one of 3 transactions that is happening on the chain is actually a payments transaction. And if you categorize this, like one of the biggest vertical for us has been peer-to-peer payments. Effectively, if you look at Polygon, more than 40% of the total peer-to-peer payments across all blockchains actually happen on Polygon. And that's less than $1,000. So a lot of places like City of Lugano, the first thing that they use is Bitcoin, and most of the payment rails of Lugano runs on Polygon. There are a lot of cities in Argentina, in like Latam, which effectively go out and run on top of Polygon. From there, like the second biggest focus for us is moving ahead in the payments world, where basically it's not just US dollars, but also non-US dollars currencies as well. And if you look at non-USD currencies effectively across all the blockchains, we capture almost 68% of the total volume for non-USD currencies. In fact, Singapore dollar is the second biggest currency on Polygon, which trades overall in the non-USD world. So that is like the second thing, which is where we are most focused on. We've just started like our B2B integrations. So a lot of businesses effectively that we're bringing in right from operating systems. So we are working with a couple of operating systems, incubating all the payment rails, a couple of financial institutions that we've just signed, which are going to go out and start using and leveraging Polygon. In fact, like we hired a lot of good guys this year. So effectively, they have been like going out and doing that. I think next week we are announcing with SAP. And they have incubated like the entire payments rail on Polygon. So that is like the the second vertical, non-USD stable coins. The third is enterprise. I think from the tokenization perspective, probably we are the first layer two which has crossed like $1 billion in like productive real world asset TVL, which includes anything and everything from like money market funds, private equity, commodities, etc.
Hi, everyone. So for people in the audience who might not know what Monet is, I just wanted to recap what Monet is. We are the latest and most performant EVM L1 blockchain in the market. Our vision is really to re-envision how the blockchain is created today, taking all the learnings from the past 10 years in the blockchain infrastructure space. We want to both create like the cheapest, highest throughput chain while also leveraging like the benefits that we get today from EVM networks. So having said all of that, our approach to traditional finance today is really enabling and increasing accessibility to real world finance for a lot of users. We know that like the end user wants the easiest and most commoditized way to access financial assets. We also know that developers want the fastest and most composable platform there is to build their apps. And so in practice, what this means is that at Monet Foundation, we support all of the building blocks of a basic financial system. So this includes the rails, the blockchain that I mentioned, payments, as well as tokenization. In terms of payments, this is an extremely big focus for us at the foundation. We are supporting USDC Live on day one of mainnet, which is unprecedented in the industry. We also recently acquired Portal, which is a stablecoin infrastructure company that has worked with the likes of like WonderFi in Canada that got acquired by Robinhood, as well as a lot of other big stablecoin fintech companies in the space. And so this is really a signal that we want to ensure that our users and developers are able to get access to both the biggest stablecoin assets on Monet on day one, and also be able to launch their apps really quickly on Monet from day one.
So maybe I take a moment to explain where we sit within Cardano, because I think there's a bit of a difference between me and my co-panelists here, who mainly foundations, I guess, right? So Cardano was established with 3 co-founding entities from the outset to move it towards a more decentralized state sooner rather than later. So there is a Cardano Foundation. It's not for profit. It's based in Switzerland and does things that most foundations would do, like propagate the ecosystem. I'll simplistically describe it that way. There is then input-output group. So if people are familiar with Charles Hoskinson, who's the founder of Cardano, that's his company. That historically has been responsible for the R&D side of the blockchain. And then there's ourselves, Emergo. And as I mentioned a second ago, our mandate initially was to facilitate commercial integration of the blockchain. Now, where we are now in 2025 is that Cardano is extremely decentralized. If you're a holder of ADA, you can vote on all sorts of governance proposals that are put forward. So the founding entities are just one of many hundred or thousand, indeed, players within the ecosystem. So we are, if you like, parents where the teenagers are leaving home, you know, if I can use that analogy. So that allows us to now say, well, what do we want to be, right? And at its core, we want to be a Web3 finance company. I say Web3 because we are chain agnostic. So I quite often use the analogy that I don't need a chainsaw to cut an apple. I just need the technology that's fit for purpose, right? And the same applies in how we're thinking about various problem statements or opportunity statements within the finance realm. And the second bit is finance. So we're not using blockchain for all those splendid use cases that the blockchain can be used for. We definitely want to go after the finance piece. So coming to the question, we have a very, very strong thesis on real world asset tokenization. Now, some of that is narrative and some of it is landing. We definitely see stable coins right now being mot du jour, right? We definitely see that certain real world assets are being tokenized, and there is incremental utility and incremental value in tokenizing, but not everything needs to be tokenized today, right? So again, our thesis within the real world asset tokenization space is private credit. That's where we see a real monetization opportunity today rather than in a year or 2 years from now.
When you say private credit,
Sure. So, I mean, there is a waterfall of more liquid and less liquid. So the reason we point to private credit is because it's by definition bilateral, opaque. You know, it's a space that would benefit from being digitized, but while we're digitizing it, let's tokenize it for all the good reasons that tokenization is a good thing, be it fractionalization, right? Ownership, you know, scarcity, proof of scarcity, etc. Um, but within that, we have maybe, for example, something like invoice financing. Now, it depends on the product specifically. Is it factoring? Is it invoicing? Sorry, I should say sales versus factoring. And what market is it in? So you've got certain parts of the world where you can get a pretty good return with a pretty low credit risk, right? So that would be something that we'd be interested in. Reason being that if you tokenize that, rather than trying to sell it back to traditional institutions, you can now sell it back to crypto natives, right? All of whom I'm sure have balance sheets that do this all day long, right? Because we're crypto native and there's just a huge amounts of volatility. So as we go certainly into a bear cycle, I'm sure there's a lot of crypto native institutions that want to hedge some of that volatility. And if you can do that with I'm going to call it a good asset, low credit risk, generally decent returning, that's a good place to hedge myself.
So Stellar's been out there for the last 10 years, and we're a proven network. We've been doing payments on chain for around like last 10 years with 99.99% uptime. And we're one of the few chains that's powering on-chain settlement, end-to-end payments, right? So that gives a reliability aspect. In addition to that, we have built-in compliance features on the network. So these are very crucial for institutions and also builders. And when I say compliance features, I mean for the asset issuers, callbacks, and also we have built-in KYC data flow. So if you are building any type of regulated payments or any type of basically payment-related issues, you need to be able to use tap these like compliance features. And this is one of the reasons why, I mean, we focus on everyday financial instruments, and we want to basically create equitable access to the global financial system. And this happens through access and distribution, as you mentioned. So we basically set the stage for anyone can build any type of payment-related stuff, payment-related projects or initiatives in a network where it creates interoperability between different payment rails in different countries or different financial networks. So that is one of the key of what differentiates us. And another thing is the enterprise grade partners. So I mean, all of us here work with very big names, but it's really important. Let's give an example with MoneyGram, right? MoneyGram is a big giant. They have around like 500,000 distribution points. That's on and off ramps. And if I'm a new builder, if I'm starting a project, ability to integrate MoneyGram to access their on and off ramps create a huge advantage to them. So that's basically what sets apart. We're a proven network, built-in compliance features, and create this network of companies working together to create the interoperability layer.
I definitely want to come back to the conversation of on and off ramps because it's probably the most highly fragmented piece of this entire stack that still is not solved. So we can circle back to that piece, but wanted to also just give the other panelists an opportunity to just mention again, in a world where the enterprises, the institutions that everyone is targeting wants as broad sweeping distribution as possible. How do you help them understand, like, this is how we're differentiated, this is why you should care?
So one of the examples that you actually took was Apollo, right? And I think so. Apollo's like the credit loop strategy that you were talking about is live on Polygon since day one. When you look at like blockchains, one of the biggest thing that you have to look at is if you look at any big fintech, none of those fintechs actually just enable payments. Like if you go into any app, like you go to Grab here, you go to Revolut, you go to Robinhood, you go to any other app which is like a fintech. they are not just doing money movement, they're always doing 10 different things. And that is where their ecosystem exists. So your money is useful in that ecosystem, and that is why they flourish, which means that your money, once you receive it into, let's say, Revolut, you can actually go out and load it in your card and do like a debit card transactions. You can get your credit cards from there, which you can pay from your Revolut itself. Then you can invest within the Revolut app itself. So effectively, when you look at an ecosystem, and like if someone is just like, okay, we will go out and like we will just focus on one particular thing, the biggest challenge is your money is going to be staying only till the time you're making that payment. And you never make money while you're making the transaction, because effectively this will be commoditized to a place where if you're charging something, there is another one who's not charging anything, and hence your value is zero. So effectively, what you have to do is once your money actually enters the ecosystem, you have to give it everything. So like this is how like when you look at Polygon, one of the biggest things that we have done is we've created that distribution across the world, which means you go to any country, like any major country which is there. You go to Philippines, there's Gcash. You go to like Singapore, there is Grab. You go to like India, there is Reliance Jio, there's Flipkart. You go to Europe, you have Revolut. You go to Latam, every big fintech of Latam, dLocal, Eldorado, Mercado Bitcoin, Mercado Libre, everyone has Polygon Rails, which means that what we provide you is like a global place where you can move money irrespective of where you are. So you do not have to think about multiple places to go to. And that's not it. Then even from the investment perspective, if you go to US, like you have Securitize. If you go to like Middle East, you have to like there's a partner which is coming in. If you go to Europe, you have Apex Group, Tokeny Group, you have Cashlink. A lot of those already exist. 21X is another one. If you go to like, then again, here we are just launching probably next week with a couple of parties in China, Hong Kong. So effectively, what I'm saying is like, irrespective of where you are, your blockchain has to be the underlying infrastructure. But effectively, you do not have to care which country you are, and then like figure out, oh, where do I need to go, which chain I need to use, because effectively that is where the distribution comes in. And this is one of the biggest things that effectively what we have done is, and that's why a lot of companies actually are coming to us and they want to work with us because of that simple reason, because we can allow you to access, and we are helping a lot of businesses expand like out of Africa to Latam, from Latam to across the world. And that is like where we are seeing like a good ecosystem coming in. And everything that you need, like a card, a debit card, a credit card, an on ramp. So we like we'll talk about on ramps as well, but like more than 150 countries there where you can on ramp, off ramp on Polygon. So effectively, that is what we've created over like the past 7 years when we talk about Polygon.
So that's helpful. So in a one word summary, I think what you're saying is distribution. Got it.
100%.
Okay.
I'll touch on distribution probably from the point of view of like the tech that we're trying to build itself. So we're trying to re-envision what EVM looks like. I think if we talk about distribution, in the blockchain space, a lot of volume and a lot of users are still on EVM networks today. I think last I checked, TVL or total value in ETH itself was $85 billion as of yesterday. Solana is maybe like 10 or 11. And the reason why a chain like Solana has gotten a lot of traction over the last couple of years is because developers have found a lot of performance faults, for example, on the existing EVM network. So what we're really trying to do is provide developers the distribution that they can still get from EVM networks today, the distribution that already exists there, while also benefiting from the improved performance that we're bringing to market. So re-envisioning what speed looks like, re-envisioning what cost looks like, and building all of those characteristics that you typically would not find in an EVM chain today from the ground up. So reasons why developers would choose Monet is one, from a scalability perspective, we're able to process transactions at the same rate that a typical player like Visa today processes, in terms of like not just transaction throughput per second, but also just computational ability that's inherent to the network. The second thing, as I mentioned, is that we're EVM compatible. And this means that, you know, like your infrastructure players like Fireblocks, BitGo, all of those companies and fintechs, as Aishwarya has mentioned, it's already going to support us from day one. We're able to provide distribution that exists to developers from day one with just the pure presence of EVM compatibility. So in combination, like those two characteristics is what I believe we really bring to fore that developers can benefit from.
So I think I wear two hats, right? So I'm wearing my Emergo hat, which is we are chain agnostic. And so I'm going to talk about distribution one way. And then I'm wearing my other hat, which is we're a co-founding entity of Cardano. And so I'm going to talk about Cardano. So maybe I'll start with the Cardano piece first, right? So ADA is third generation blockchain. It's been here for what, 8 years at this point, right? It's a top 10 cryptocurrency. It has had zero downtime that entire time. It's a very, very robust technology stack. If you're using, so I make a distinction between Bitcoin and everything else. Bitcoin is just currency. Everything else is a tech stack because it's got smart contract functionality built within it. It's a technology stack. If you're an institution, if you're a corporate, if you're an individual, you just want that stack to work. That is the basic minimum requirement, right? And so, again, what is it you want to achieve? And is there a tech stack that is fit for purpose? You don't always need the best tech stack in the world for the thing that you need to get done, right? The analogy, again, I gave is VHS versus Betamax. Betamax was a superior product, but porn went to VHS, and VHS won that battle, right? So there's that kind of that thinking in play. When it comes to Emergo ourselves, because we're chain agnostic and we simply want to build either using blockchain as an infrastructure to allow assets to go back and forth, or we're using crypto as a product so that we're mainly institution focused, right? So institutions can look after their treasury or grow their treasury in some shape or form. All of that for us leads to tokenization in some shape or form. But tokenization in of itself does not lead to incremental liquidity, incremental utility, or incremental value. The three components to solve in my mind when it comes to tokenization is demand, access, and distribution. Right. So how does tokenization facilitate distribution? In of itself, it doesn't. Fractionalization suggests there should be greater liquidity, but creating those marketplaces in the middle to allow buyers and sellers to meet is critical.
I think that's helpful. And, it's interesting. We talked a lot about like fairly complex systems. And, developers in this room or developers in Web3, like they have the grit and the intelligence and the motivation to figure out those complex systems. But when you're speaking to, let's say, a bank or a global asset manager, now they're used to their traditional systems, but they're not yet motivated or maybe educated enough to figure out these new complex systems in blockchain networks. And I think that's changing, which is great. But when you kind of flipping to now the side of actual use cases, when you go into an institution, you're speaking to them, what are the use cases you're seeing that are most consistent? And maybe we'll start in reverse order and come down the end. I mean, I've seen Morgan Stanley announce that they're going to bring buy, sell, hold, with zero hash to their customer base. Swift just announced a blockchain project with Linnea. These are, traditionally very large core infrastructure players in capital markets. When you go in and you're talking to partners, what are the use cases that they can get on board with that they're excited about that is, lower lift than say, building a Tempo or building their own, their own network?
So there is definitely a spread, right, of education, awareness, appetite, 100%. And so because we're not a foundation, we are for profit, and so we have incentive to find a product market fit and a monetization opportunity more so than spending time and effort on education. So that's just very loud in our minds in terms of how wide that spread can be. I think that for institutions, but overall, there is a bit of a stepping stone, right, from, should we call it fiat today to maybe Bitcoin, right, as the digital asset. So in between, there's a series of stepping stones where there's all of those things: education, awareness, cultural acceptance. Stable coins is, like, for me, is the first stepping stone, where people say, okay, I don't quite understand this whole Bitcoin thing, but I get that we're now putting fiat on rails, and it can go from A to B quicker and cheaper. So there's definitely greater appetite within the institutional space to adopt stable coins, right? Just cash management. If you can fund your group, if you're a conglomerate and you've got subsidiaries all over the world, you can fund them instantaneously. That capital that you're saving by not having to waste 3 or 4 days while cash settles is enormous, right? Past that, I think we're starting to see I'm going to call it green shoots of understanding of what tokenization can be for other real world assets. And I think that then goes ... through to pure digital assets as opposed to digitized assets. So I think, to answer your question, there's a proliferation of acceptance of stable coins now, and that will go to certain parts of real world assets.
Well, yeah, because then during that 3-day period that cash is settling, they have to figure out what to do with their new capital efficiency.
Correct. Exactly. How are you going to make it work for you? Right.
Yeah, I think I echo a lot of the points that Nikhil just made. I think a lot of institutions have adopted a wait and see approach. So in the first, I don't know how many years of like digital assets have existed, they've seen users adopt Bitcoin and a lot of these digital assets. And then they've seen fintechs like Revolut, Mercado Libre bring these assets to the public. And then now they're seeing governments come on board in like a serious way. So not just with like the Genius Act in the US, but also in emerging markets all across the world. Like even the country where I'm from, like Malaysia, the central bank has traditionally been extremely anti-stablecoin because of strict capital controls. But they're starting to realize that they can no longer just ignore digital assets as an asset class, and they're starting to regulate and be a lot more friendly towards the asset class. And so institutions, I think, once they've seen governments come on board, like now they're saying, okay, we need to put together our stablecoin like working groups. And to your point, like there's a really wide variety of use cases that they're exploring. I think one is definitely settlement. Just the inefficiencies of having to tie up like working capital when they pre-fund like liquidity requirements, sending money across borders, being able to use stable coins to instantly settle saves them the inefficiency of having to spend that working capital. And then on the other hand, on the retail front, like a lot of them are also thinking about offering trading products or wealth management products, saving in digital USD to their user base. So it's definitely a wide gamut of use cases that we're seeing. But the great thing about where the industry is today is that because of government acceptance, a lot more institutions are now willing to explore like these use cases.
Yeah, I think I'll just add like 2-3 lines more on that. The first thing that a lot of these enterprises and governments are looking for is a trusted partner. The biggest challenge from the last cycle to today's cycle is, in the last cycle, people were like, okay, you're the blockchain, amazing. Now we want to do this. And the blockchains would be like, yeah, here's a partner, you should do it with them. And then they say, we want to do this. And then here's another partner, you do this. So I think that was one of the biggest thing as a challenge that they used to face. And now like when we're talking to a lot of governments these times, and a lot of like top financial institutions, everyone or no one wants to actually just go out and say, can we launch a chain and can we use a stable coin? And that is why this strategy is failing. Like a lot of blockchains effectively just go out and say, okay, we'll give you tens of millions of dollars and then you figure out your strategy. And the beautiful part about this is this cycle, a lot of serious players which are coming in, they're like, no, you keep your money. I don't want your money. What we want is partners who effectively can come in and help us co-build this project or like take this to the next phase where we I think 2 days back I was talking to one of the biggest real estate developers of Middle East. They called us up and they were like, okay, we are real estate developers. If you tell us we can tokenize the properties, I have no idea about it. If you think like this is valuable, you need to prove, you need to work with us hand in hand and get us to build everything with you. You can take like 50% of the company which we want to build and all those things. But effectively, all these serious players, they're all now looking into like how we can actually partner with the blockchain on different levels. So one is basically nobody's like most of these serious partners, they're looking for people who can end-to-end help. And the second thing is also now getting onto the blockchain side, where effectively what is happening is if blockchains are very much reliant on third parties, they effectively in the next 2 to 3 years will lose a great chunk of their deals.
What define third parties?
Third parties, as in like if you want to launch a stable coin, then you go, oh, here are like 10 different partners. Like this is like the mental trauma when you introduce a fintech to like 7 different partners who can help you launch a stable coin is like ridiculous. They
You mean the issuers, the
yeah,
stablecoin issuers?
just like issuers, like think about like they have no idea how to issue, and then you throw 5 partners to them, and they're saying we can do this for you, we can do this for you, and they're like, I don't understand half of those things.
And they don't have the ability to differentiate
Correct.
between the issuers.
So effectively, this as a strategy, while used to work like in the last cycle, in this cycle is not working out because a lot of these guys are like, you tell us, we trust you. If you're coming and working with us, we trust you. Why don't you figure out? And like, so one of the partners that we are probably like launching in next month is like a $4-5 trillion asset manager. And the only reason why they came to us was they said, you guys have the expertise to kind of go out and do this XYZ thing, which we are looking for. And can you go out and do this with us? So effectively, the idea is like, we are not kind of going out and like actively talking to them. A lot of partners are now coming to us.
Got it.
And that is like something which is changing a lot in this cycle.
I want to give you a chance too, and then we got to get to our hot takes because we're running low here.
Sure, yeah, I'll be quick with this one. So we've been doing stablecoins for a long time, and what I'm seeing is that stablecoins was perceived as a crypto asset, now is type of commercial money, and everyone, I mean, as he said also, back in the day, stablecoins or the tokenized assets were like, oh, what is this? Like this is allergic. I'm allergic to that. What is the value? But now big institutions, but also small players are coming to us, and to use the stablecoin rails to create efficiencies for them and interoperability for their payments. Ultimately, we're all here building a global on-chain economy, and stablecoins are the local access points on how we can get into this global on-chain economy.
I think that's a really nice, like, unifying way to end the panel. But first, down the line, 10 seconds max, number one hot take, next 12 months in this space of traditional finance and payments. What's the hot take? What are you seeing? What do you anticipate?
That is a great question. So everyone is talking about how stablecoins are cheaper and all that. I actually disagree with that. Everyone is saying how stablecoins are creating or making cross-border payments better. I also disagree with that. Right now, there are a lot of dependencies on the first mile and last mile. So basically, stablecoins are just changing the format of money or the usage or the rails of money with a different rail. But the moment where we get into the on-chain settlement, the moment where we lower the dependencies to the first mile and last mile players, that's where we're going to see how stablecoin can power the future of
Last mile meaning off ramping.
Oh yeah,
Yeah.
That's my last mile.
Yeah, which is okay.
I think from a stablecoins perspective, like I think we have already talked about being cheaper. One of the other things that I would always say is the rates that you would get on the forex of on chain would never be better than like traditional rails. And the reason being because like there's so many costs which effectively are embedded on ramp, off ramp, slippage, and then so off fees and all those things together. So effectively, you would never find like on-chain rates better than like off-chain. But the caveat is when you club it with treasury management, hedging, and like movement of money, it is more effective.
Okay.
My hot take is that there are too many stablecoins on the market. I think there's definitely going to be.
We're gonna see more. There's gonna be more.
It's definitely a fragmented market.
Yeah.
Yeah. Well, I'll say stable coins because everyone else has. I think there's going to be a lot more stable coins. Every bank is going to start issuing them. I think the Web2 players are going to become the distribution agents for those. There'll be a lot of money made, and then there'll be too many stable coins. Private credit tokenization, I'm going to say that because that's our big thesis. And I do think that that is where there'll be appetite to start earning yield. And I think for the next year, DATs will be a thing until they blow up in a very nasty way.
Oh, no. All right. Well, if you could all join me in giving a hand to our panelists, thanks for joining. Thank you, guys. Thank you so much.